Clara Hermit, and this is our regular look at the financial markets with Investment Director Russ Mould. This is Mould on Markets. Mould, how are you?
I'm very well, Miss Hermit. How are you?
Yeah, not too bad.
Delighted to see you.
And you too.
Pleasure.
What is it that advisors and their clients should be thinking about at the moment?
Yeah, well, anyway, I think it's actually time to revisit a well-known, well-worn, much-loved market saying. You can have cheap stocks and good news, but not necessarily both at the same time. Now, what does that actually mean? Well, we all know that buying low and selling high is the name of the game. So what clients and advisors really need to be thinking about or looking for is markets that are cheap and unloved. Potentially be a bit more careful with those markets that come with a strong story and plenty of good news, but where the valuations just could be a little bit more toppy.
So without giving anything that could be misconstrued as advice here, where is the value right now?
No, I definitely won't be giving any advice, I absolutely promise you. But one thing that you can do is try and look through market data and look for markets that have done badly that are now doing better and markets that have done well that are now doing worse, just to see if the market's giving you an indication where it thinks value may or may not be. So this first chart shows the 7 major global regions, the US, the UK, the Eurozone, Japan, Eastern Europe, Asia ex-Japan and Latin America, and looks at the performance of their leading equity indices in 2015 to date. Now it also does it in sterling and not local currency terms, because in the end, that's what clients will be taking home with them and taking it to Waitrose at the end of the day. Now as you can see, the best performers are Eastern Europe, Japan and the Eurozone, while the laggards are America and Latin America.
Doesn't that basically flip last year's figures around on the head?
Very good, yeah, top of the class. It does, as the chart behind us shows, and this is sort of the point really. It's normally very hard for a market to outperform for a very sustained period of time because ultimately lofty valuations start to weigh on it, and also unloved markets tend to rebound as a lot of the bad news there is already factored into valuations and discounted. In those cases then it sometimes doesn't always take much to attract the market's attention and start creating positive surprises. So if you think about it, last year Eastern Europe, just about anything that could have gone wrong did. You had geopolitics in Crimea and Ukraine, an oil price collapse. The Moscow market plunged. This year, well, Ukraine's still a bit of a mess, but oil has bounced, the Russian ruble has recovered, and Moscow's RTS index has rallied, dragging the whole Eastern Bloc with it. Now, by contrast, we've talked about this a lot, American economy in Q1 hit a soft patch, strong dollar, port strike, bad weather, and that slowed American equities march down a little bit, especially as valuations like market cap to GDP or Robert Shiller's CAPE, cyclically adjusted price earnings ratio, they show that America is trading at or above historic average valuations right now. So in this next chart, I've taken each of the 7 regions' annual performance back to 2005, ranked them 1 to 7, 1 for the best, 7 for the worst. As you can see, America's had a great run of performance, whereas Eastern Europe had been in the doghouse for 3 or 4 years, and those performance trends now look to be changing a bit.
So what do these charts look like for the other good performers, Western Europe and
Yeah,
Japan?
so we've sort of done one good performance, which is Eastern Europe. If you look, the rankings suggest that they may have a bit of a tailwind behind them. And again, with the European Central Bank and the Bank of Japan full tilt quantitative easing, it may be easy to see why the markets thought, well, let's give them a chance, because again, they'd underperformed for so long, certainly since in the early stage of the global bull run in 2010, 11 and 12. On this chart, I've also cheekily thrown in the MSCI Latin America, just because it's had such a rotten 4-year run. Again, you can easily see why. Commodity prices have gone down, Venezuela and Argentina, inflation-racked basket cases, Brazil trapped by corruption scandals, soft commodity prices, sticky inflation, rising interest rates. So it's a litany of woe, but it'll be interesting therefore to see if the market ever decides valuations are getting more interesting here, because those stories are now quite well known. Again, big risks abound, and advisors and clients should only ever consider a market if it fits with their long-term objectives, target returns, time horizon, and ultimately appetite for risk. So some of these areas will be just beyond the pale, but it will be intriguing to see how they start to perform.
Okay, thank you, Russ.
Pleasure.
Thank you to you for joining us. We'll see you next time. Goodbye.